EHL recap for cost control. Just a small rundown, we are a student-run organization. We post free content during midterms and finals for students by students. We give a short presentation and answer all of your questions at the end of the call. We post content exclusively on our website at ehlrecap.tk. If you forget the link, don't worry, you can always log into our Instagram, ehl.recap. We have reminders on future recap sessions and anything else you need to know. I have sent both of these links in the group chat. We aren't affiliated with EHL, so don't keep us accountable if you fail. However, we have worked with professors and students who have taken this class before and to put up this material and make sure it is up to proper standards. Kim, take it away.
Hi guys, welcome to F&B Cost Control. You know why you're here. Let's start. So I've organized the whole session it's the same way as Professor Woff did, William Alexander François. Basically the same structure. So yeah, I'm not going to spend too much time obviously on the beginning, but then a bit more towards the end. So let's start with the intro. First of all, the viability of everything we do in F&B cost control, basically the big picture of it. We have the external factors, the family circle, internal environment, and product life cycle. The product life cycle is pretty important, obviously, because that's where we have to innovate. Otherwise, also we've seen, so in microeconomics, we are making less profit over the long term. But basically just a recap of the first session. What can we impact as managers? Pretty much also self-explanatory in this case, this you all know. And what I wanted to point out as well is the difference between commercial and institutional F&B outlets. Commercial basically are profit oriented and visible in the public and advertised, obviously. So we want to have maximized profit, and in institutional F&B outlets are non-profit oriented or cost driven as well. So that means they have to keep the cost to a minimum, so to save money and obviously mass consume. And obviously they're not advertised in the, for most of them not advertised because they're not public. So
sorry, could I ask something?
Yes.
What's the difference between institutional and non-commercial?
Institutional and non-commercial, well, basically almost the same. It's just that institutional are institutions that are let's put it that it's with hospitals, for example. They're official places like hospitals or like schools or anything like that. And non-commercial are, for example, for companies. So companies, they would offer maybe lunch to also external guests for some reasons, but yeah, it depends on where you are. But institutional is definitely the more government side, if you would say so, and the non-commercial is affiliated with a commercial business mostly. Is that okay? Answer your question?
Yeah, thank you.
Perfect. Awesome. So profit affecting factors, what we have is a fragmented and concentrated market. So a perfect competition oligopoly with, you also revised that now for microeconomics, I think. Then segmentation is a geographic, demographic, psychographic, and behavioral. Also with looked at this marketing. This depends on how you market, on how you are placed, and what you do in terms of product. Obviously, if you do this wrong, can affect your profit negatively or positively in the way. And of course, external, the pestle analysis, political, and so on, is important, obviously, because it has an effect. We can't really influence that, as we've seen. Low profits, which is badly managed, because I think in Switzerland we have an average profitability in restaurants over about 6% or 8%, which is really low technically. So there's not a lot of people knowing how to manage cost. Local culture, so does the concept fit the local culture? That's obviously something that you have to know. In Switzerland, a lot of people are very conservative with the food, especially the Swiss-German part where I'm from. Fragmented and concentrated. So what we have a fragmented market is basically where you have, it is mostly from a surface point of view. So basically fragmented is where you have a lot of restaurants scattered almost. It's basically like not on the countryside basically. that's a very fragmented market, so you have long ways to go there, and in between each business, and concentrated is, for example, city center, where you have a lot of businesses on a very small space, basically. Yeah. And then also about the market, obviously, where you are operating. If you are, for example, if you are the only 3-star, like Christian, for example, you almost have a monopoly there for fine dining in Christian, because there is no other place around. So this is a very fragmented market in that case. Cool. Then failure rates, obviously very high, because we have low profit. So that means people are going to be driven out of markets or mature industries, sorry, where there is already a lot of competition, that saturation is very high, so a lot of people are getting less profit. We saw that in microeconomics. So the longer a market is in place, the lower the profit, the lower, and this at some point, businesses are going to be driven out. Yeah, it's being recorded, Alex. Perfect. Bitte schön. Here we go. So go to expand a business model. This is what we know, everyone, is input, transformation, output, which is what the basic is. But also what we have after the output is a feedback. So we can do it qualitatively or quantitatively, with different measurement systems, with feedback forms from customers, from clients, etc., etc. This goes back in the control process, where we set new standards. We analyze the feedback, put it back into feedback and standards, and then we put it in memory. So we store it and put it back in the cycle, where we input transformation, but then also obviously we have to control this if the new standards that we're setting are actually helping us achieve greater satisfaction, greater profitability, etc., etc. Also, not too difficult, I guess, but just worth mentioning. So as to have the overall
Sorry,
picture.
what's the difference between the first 3 ones, and the last 3 ones? Because in the past paper he had given us, he was saying about control, memory, and feedback, whereas I thought it was input, transformation, and output.
Well, basically, this is the expanded one. So this is what happens in between and after, especially after the first input, transformation, output. And this is just steps that happen that we have to take as a business as well, in order to feed it back into our basic business model. That's what we have to do. And what was the question, by any chance? Do you know by any chance the question? That was about the control, feedback, and memory?
Yeah, wait, I have them. Here they are. No, I have them somewhere. Wait, I'll look for them and I'll tell you.
No worries. Okay, cool. Good, let's move on. If you find anything, then please let me know. We'll go back, but yeah. So, here we go. Yeah, that was the first part. Pretty simple. Now, revenue and expenses. Do you guys want to look at the vertical and horizontal analysis or not? Because this was one of the main parts of the analysis of the Excel sheet we had to do of the cost of the case study. Anything you want to look at specifically or not? Should I continue?
Yeah, I think we should go over a bit, please.
Okay, yeah, for sure. Thank you, Jonathan. So basically, horizontal analysis, we have the analysis of trends, which is definitely of different periods of accounting periods, for example, or just monthly, quarterly, and so on and so on. And this is basically the same numbers that are going to be compared to previous numbers or future numbers if you're doing a budget. And vertical analysis is top-down, where we are taking certain factors into consideration. Let's quickly see that here from the case study. An example, this is our work from the team 12.2. It should be correct. We got all the points for this. If you still see a mistake, just let me know. So we see what we have here is, in this case, on the right-hand side, where I've put a red circle around it, this is the horizontal analysis. So what we did is we've compared the variance with last year in terms of numerical values. Is last year's value minus the actual value divided by last year's value again, divided by actual value. I have to check one of those. And this is basically, we see a trend in what variance it has. Including classic versus expanded business model. Okay, yeah. Again, if you have the question or the specific, then I'll answer that. Basically, yeah, the trend analysis, as I was saying. So if you have positive, obviously positive trend is, in this case, an increase of 5.3% in total covers, or with the budget is a minus. So this is basically how you calculate that on a horizontal level, which is interesting to see, obviously, where we're standing in terms of budget or in terms of our performance. And then for the food and beverage, very important that we are analyzing out of the 100%. The 100%, though, is not the cost of goods sold that we're taking into account. But we are taking the beverage and food and beverage revenue. We're taking all the food and beverage revenue we are calculating as a percentage of the total. So that means the 2.8 million, for example, is 64.59% of the 4.37 million Swiss francs or euros. So this is very important to not forget that you have to calculate as a percentage of the food or beverage cost each. That's the horizontal and vertical analysis, basically. So let's go over to variable and fixed cost. Basically, variable costs are everything that changes with an increase in production or an increase in quantity that you have in a business activity. So, for example, it's cost of goods sold. Obviously, if you sell more, then you are increasing your costs. Sell more carrots, you have higher costs. Obviously, variable payroll, which we've been talking about as well in the labor costs, but variable payroll, obviously, people that you take on part-time and that you have to pay. Other operating costs and cost of energy as well, obviously, more energy consumption. These are just examples, it's not a conclusive list. And fixed cost is everything that remains the same regardless of your activity, which is fixed payroll, renting fees, etc., administration staff, subscriptions, and so on, which is basically not affected by your activity as a business. So prime costs. Yeah, okay, Harry, just answered that. Perfect. Okay. Food and beverage cost is a cost of goods sold, but the food and beverage revenue, as I said, is a prime cost. This is the ratio we have to look for, and the labor cost is part of the total revenue bar. Though this is the difference between the food and beverage costs and the labor costs. The labor costs we're calculating as a total of the total revenue. Perfect. Direct costs. We see that this is something that can be directly applied to goods or services. So, for example, materials, manufacturing supplies, etc., which have a direct impact on what we produce and how we produce it. And indirect costs are everything that's can't be attributed to what we do or what we put out in the end. So not accumulated to dish. So, for example, if you have a general office expenses or employee salaries or professional expenses, this is not really something that technically helps us or has an effect on how we the dish we sell, for example, in this case. So KPI forecasting. Main types of KPIs, we have quite a few of them. So I'll just go over the main ones we've had as well in the class. So seat turnover, number of covers divided by number of seats, which gives us 50% in this case. Quite an easy calculation. Then seat turnover, if we have an average daily seat turnover, we have how many lunch and dinner reservations we have, or how many covers we have had, and divided by the number of seats. Now here we see that I've taken 160 divided by 160 because we have 80 seats for lunch and 80 seats for dinner. So that's why we have to add them together and divide then the total amount of covers we had by the number of seats. Now, occupancy ratio, what we've had here is we have a number of seats is 680. We have number of dinner covers is 160. Seat turnover is 2. Average cycle time is 50 minutes, and dinner served is from 19 to 23 o'clock, which means that we have 4 hours of dinner service time, which is the 4 here. You see, then times 60, which is 60 minutes, because we have to calculate it by 60. Then we divide it by 50, which gives us the 4.8, which is the average cycle, the perfect cycle time. And then we have the seat turnover divided by the perfect cycle time gives us the 0.416, which is times 100 is 41.6%. This gives us the occupancy ratio we've had for this specific time in our restaurant. Service cycle time is basically what we do is an average over all the tables we've had. So now we have 80 tables. I just have 4 here. Depending on how long they sit, from when they sit to when they pay and leave, how long it takes, and we stop the time, and then we divide it by the number of tables we have. Obviously here it's 37.75, which is in this case we're rounding it up to 38. So because we're calculating a bit more conservatively, so we have a bit of a buffer in that case. The RevPAS is the revenue per available seat per hour. So what you are doing is basically the amount of hours you have divided by the number of seats times the average check, which then gives you a number of 36 euros per revenue per seat per hour that you have here, because you have 60 minutes service cycle time as well.
Sorry, could you please show your previous slide again?
Yes.
Great, thank you so much.
No worries. Perfect. That's basically just to, what the average cycle time is. How you get that average service cycle time here, how you get 60 minutes in this case in the RevPAS. Then square meters and average rate. Sales per square meters, not really interesting for a restaurant that has a fixed amount of square meters, obviously, but is very important for catering businesses, because obviously now with COVID, they can't do that, obviously, but they need to know how much they're doing per square meters so they can improve with different seats, with different tables, different shapes of tables. So just that they, that they are maximizing the revenue per square meter. And the average rate is the sales of food and beverage divided by the total covers, which is the average rate or the average check, however you would say it. This is very important for forecasting, because when we know how much our customers spend, we can adapt to our menu, we can adapt our forecasting. Yes, Harry?
Just a question. It was a question from Natalie about, is it possible if you can give an interpretation of the result? So why is it important to calculate, RevPAS and also
So
also, yes, everything you just explained.
Yeah, of course. So basically, all the results we have, it helps us to have an overview over our business. So what we need to know is that we have different indicators and we have different ratios. So I'm just gonna quickly go to the first. These are all the key performance indicators. All these ratios that we have here have been developed, obviously, to keep track of the performance of the business, which means that over time we know what we have to react to. Because if you, how do I put it? The more you know about your business, the more you can calculate, the better you know your performance, and the better you can improve it. Especially because I've said before that we have quite a low profitability overall in F&B, in Switzerland, for example, or in other countries as well. So we have to know how to what our business looks like at a given point in time. That's why you calculate those ratios, and that's how you can use them to improve costs, cut down costs, and improve your profit. Did I answer your question?
Yes, thank you very much, man. Thank you.
Okay, perfect. Awesome. Now, break-even point. So the marginal variable cost is, or contribution margin, which is the revenue minus the variable costs. That's what you calculate first. And I would suggest you maybe, if you're not sure how to calculate this, copy that just on a piece of paper. You can also, it's on EHL Recap, the presentation, so you can copy it from there and just put it on a cheat sheet just as a quick reminder, so you know how to do it in the exam if you have to. So revenue minus variable costs, which should be given to you. Thank you very much. Chat, perfect. And then you have to do this. You give the marginal and variable cost as a percentage of the whole revenue. That's why you divide it by the revenue, so you get a percentage. So now the break-even point is divided by the fixed cost divided by the MVCR, and that's your break-even, just a break-even point. Now the break-even is the amount you have to gain in order to get zero profit. So it's just where costs equal your revenue. Now, how you can do that in days? So it's break-even point divided by the monthly revenue or the days. You can also do it by yearly revenue. This is very important because it can also be that you have to calculate it per year. As the teacher, William-Alexandre François, said, you normally calculate it per month, but also you can calculate it per year. This then depends. And the break-even point per guest is break-even divided by the average rate, which is the average check. So you know about how many guests you have to have in order to achieve with a break-even, and you can therefore calculate accordingly. So food costs and beverage costs are prime costs, and labor costs and operating expenses are everything fixed or variable. So as we said, labor cost can be either fixed or variable depending on how many fixed staff you have and how many staff you need for, let's say, for a special event or something that you have to hire hourly. And operating expenses as well, fixed or variable, and depending on where you're, what type are you're looking at, sorry. Here we go. Planning and profit and menu design. I'm going to be very quick with that. What information can you get from a menu? I think it's very, that's very self-explanatory, and you all know it because I think you've all seen a menu before. Then the menu determines the number of type of employees. So everything you need to know is on the menu. That's basically the information for the guest, but also for us, it's very important because for the menu, we get the recipes. For the recipes, we know how much time it takes to prepare something. And from that, we know how much space we need, how many people we have to hire, etc., etc. Break-even just for a case study. Mai, what do you mean by that?
Didn't he say, I'm pretty sure it even says somewhere on the slides that the break-even, because it's the first year that he's teaching break-even, that it's just for the case study, because also on his revision for exam, there is no break-even, I guess, because he said, I think that it's just for the case study. I'll try to find it.
Okay, perfect. Even better than that's I might have overlooked it. Okay, perfect. Yeah, so if you don't need it, then you don't need it. That's perfect, even better. Otherwise, you still have to. Thank you for the input, Mike. So yeah, that's what it said. The menu, what this determines, but also it's what it's limited by. So we cannot, let's say, there's a question on the review quiz asking about break-even. Okay, cool. So limiting factors is what we have for equipment. So we can't have, for example, a lot of things on the menu that require the same machinery. Let's say we have a kitchen machine where we make a kitchen mixer in the kitchen, and we only have one of them, but we have like 4 or 5 items on the menu that require that, so we can't use it. So this is very important that we take all of this into consideration. As a flow through, apparently not a break even that we don't have to calculate. Cool. Perfect. So for a menu design, simple, sincere, security, and seduction. Yeah. This is also very self-explanatory. The reading style also, he's probably not going to ask about that, just this is for your information. And then what do you need? An operator, wants and needs. How do you cost? That's what it said. guessed, need to have very different factors that you have to take into consideration of quality of product, production flavors. Everything is this is what you need to know as an operator and as the restaurant server. So average profitability and popularity, this is the first step in the menu engineering. That's what you have to calculate actually with the numbers you get. So average popularity is the number of dishes sold divided by the number of dishes in the category. This is important because I'm going to show it to you, I think here in the next slide. This gives you the average popularity, and according to that, you can place then on the matrix, you can place your individual menu items, and the average profitability as well is a total margin divided by the number of dishes sold per category. And this is super important, guys. Remember that it's per category, never the whole menu. So if you have starters, main, and desserts, you're only either calculating for starters, mains, or desserts. Here we go. We have the product classification. This is what you all know. Plow horse, dog, puzzle, and star. Star is high profitability, high popularity. Puzzle is high profitability or low popularity. Dog is low, and plow horse has low profitability but is very popular. So that's how you can classify. So if you have the average, you can place either above or below the lines, depending. So for example, here you have where the cross is, you have right from the cross is a very popular stuff, left of the cross above the cross is very popular, below unpopular, high profitability, low profitability. Basically how it works. So now what can we have to take decisions based on how we categorize a menu. And this is where also those ratios come in. We have to apply them to the menu as soon as we have data to actually see how well our menu does and what dishes we have to potentially eliminate or where we have to cut costs. So for the plow horse, the issues we lack in profitability. We have super high popularity, and because it's so cheap for the customer, that's why they choose it. So I've also put the arrow from top to bottom, what we should do first and what we should do last, basically in the steps on what you would like to do. So see if the selling price can be increased. Can you do that? Yes or no? Reduce cost, and how? It's always the first, with always obviously remaining the quality that you're selling. Change the position in the menu. So if labor cost is high, how can you move it? So this is also about reducing cost, hide, but have it available for regular customers maybe. That's also something that you can do. So you can play with that really to have to be also creative. This is not as I said, not everything that you can do, but of course you have to be creative. It's just a few examples. Then for stars, of course you have to keep the specifications for that, not lowering the quality. They're basically running very well and they have super high profitability, so that's cool, that's great. And can we even increase the price for that? You can sometimes ask you that as well. And you can use it as internal and external advertising, because those are the ones that will give your restaurant more traction. It's like a signature dish, let's put it that way, for certain chefs, signature dishes. Then for dogs, you have to test for price elasticity. Revisit portion size, reduce if possible, adapt the recipe, and so on and so on. Maybe you develop a substitute and negotiate prices and so on and so on. And if labor cost is too high for this, if you have a very labor-intensive dish that is not very profitable, then and you don't sell a lot, then you should definitely eliminate that. And puzzles, we can actually now, because of the, for example, on the way we read, so people read from top to bottom, so maybe we have to reposition where we put the puzzle, because it has profitability very high, so we can keep it on, but it's very low in popularity. So then improve the quality in the presentation maybe a little bit, so that will decrease a little bit the profitability, but still may increase in popularity. And if it's really unpopular, even though it's profitable, you should also not be scared of removing it. Good. Now, fifth topic, pricing. What a sales price is made of. Yeah, Harry, sorry.
Yeah, sorry. It's going back to so about dogs and about puzzles.
Mhm.
In the mock exam that Francois gave us, there's a question about that, about like, and you had to calculate, well, not calculate, but you basically had to look, and there was like a graph that showed like actually like how much of it is like popular and how much of it is profitable. And I want to know, do you have any chance? I know maybe for now it's not, but maybe like after you could post in the chat like an actual diagram that shows with numbers, because they ask questions about, like, when you calculate the average profitability and the average popularity, if maybe you have like a spreadsheet that like shows that, like how you can input those values in an actual chart to determine whether you're a dog, puzzle, or like that.
Yeah, I can just I can basically show you. This is actually very simple. If you have those values, the average popularity and the average profitability, you're really looking at the cross. Okay, so this is the average is in the middle, and everything that's right or left from it, because you have, let's say you have sold I don't know, 250 dishes, and the average is 200 dishes of the category, but you have sold 250 dishes, so you know already that it's going to be above that the popularity line, so on the top part. So it's either a claw horse or a star. So that's very easy how you can calculate that, and how you can see how you can also place it. And then of course also for profitability. So you see that, for example, you have your margin, and the margin for each dish you also normally have it in a chart. You can have calculated it, and then you can see, okay, is it above the average, is it below the average, and that will also put it very much in a quadrant. And then where exactly you place it is then depending on, maybe you have an Excel sheet or something, depending on how you want to do it.
Okay, perfect. Thank you very much.
No worries. So the sales price, what it's made of, appearance, price, brand, and reputation. Just very simple, actually. You all know it, how it goes. Of course, what we have in restaurants is experience and design. There's two very different things. Staff and food, obviously part of the experience, and sometimes even some people will say staff is more important. Atmosphere, strategic messaging, and graphics. For example, for me, atmosphere is always something that's interesting. When I go to the mountains, go hiking, and I see a restaurant with the Schützengarten, how do you say, sunshades, very cheap plastic sunshades. It's about the design, and it's not really inviting. And also with the designs, you can all play on that, obviously. So to brand your restaurant well. 3 C's of pricing policy: company, customer, and competition. Everything that's obviously overlapping each other, as you can read. One thing I will just point out is that if companies in competition only, those two are cooperating, then they can fix the prices, which that is very legal because they will overcharge the customer, and that's obviously something that we want to prevent. So that's what's forbidden by law. Cost versus value-based pricing depends on what approach you use. We've had in class, also in marketing as well as in admin cost control, we said we should definitely focus on the customer first always, because the customer in the end decides if he wants to buy the product we do or not. So it depends on which way you go around. Either it's product, cost, price, value, customers first, or then it's customers first, value, price, cost, and product. Depends on which way you want to calculate it. But it's always very important to start with the customer first if possible. Then here we have the pricing tactics and the positioning. So we start first with the skimming strategy. This is the maximum, so we go in price, maximizing profit, and have super high return on investment. So we're also only gonna charge a very small percentage, or target a very small percentage of the clients, just to get a maximum price. The people who have the buying power, so to get it. Alignment strategy is what we do is we're maintaining our market share and follow our competitors, just ride the wave, as we said, basically. Penetration, is increase the market share with a market disruption, for example. I don't really have anything like an example here from the restaurant industry, but what I can say, like for example, OnePlus, a Chinese mobile phone brand, they've come out with a flagship killer for the tech people among you. It's basically a phone that has very high levels of performance, but to a very cheap price. And this is the market penetration. You go in with a very good product at a lower price so as to increase your market share and to get into a market that's otherwise very competitive. And then survival, to cover your least, your variable cost, and this also can be tactics. So survival strategy for certain products obviously doesn't work in the long term, but for example, if you're introducing a new product and you're fading out another one, this can be a strategy to have a lot of discounts now that a lot of shops are doing that in a new year. A lot of skiing gear, for example, you can get for now very cheap because it's almost after season. I don't know, they already have sales about that, for example. So this can also be a strategy depending on how you price it. Then how these are the three main strategies are done. You can read it. I won't read everything now, but you have everything on EHL recap as well. Then price variances, supply and demand. Obviously, this is the main one. You can't sell something for a way too high of a price, so no one will buy it. That's obviously something. Inflation, marketing activities, and promotion. That's also another one. Competition, you have to take the competition obviously into consideration. And Jonathan, yes, so survival pricing can be a seasonal strategy. Otherwise, it's foolish to go for this strategy. Yes, correct. Yeah, because survival won't work because you won't really make profit or a lot of it. So it won't work over the long run. But yeah, exactly. It's time limited, I'd say.
Okay, thanks, Kim.
Perfect. And yeah, that's the variances. Then you have different tactics, obviously, in what you want. Discriminatory pricing, happy hour is a very popular example here. Promotional pricing, which is the cash discount. You get coupons, etc., etc. Product mix pricing. Basically, this is just have a quick read through it. It's basically just to understand what different tactics can be. I'm just going to have a sip of water. So here we go to the markup factor. This is very important because what you do with this is basically you can apply this factor to all your dishes. So it makes it easier for you to calculate it. If you have calculated it once, you can apply that to new dishes you do based on your cost. You can just apply this factor, and then you will automatically get your selling price. So it's this gross profit divided by the cost of unit. Gross profit is cost per unit minus sales price minus cost per unit divided by the cost of the unit times 100, and then that's what you have here as well. So step one is you have divided the 100% by the desired food cost, which is the markup, the pricing factor. This is how much of the percentage of the food cost you want to have. So that means, for example, if you want to have 20% of your dish is the food cost, then you can apply this pricing factor of 5, which is 5 out of 100. And that's basically the cost of the dish, excluded VAT. Perfect. So the gross margin, average unit gross margin method is cost of non-food plus desired net profit equals the gross margin. And then the unit gross margin is the gross margin of total divided by the number of expected customers. So that's what you do per unit, the gross margin, and the defined selling price is the cost of dish, and the unit gross margin equals the selling price. So this is a different method of pricing, which is either the markup here, which is with the pricing factors, or the average unit gross margin method. This is a bit more complicated to calculate, but can also be a way. So So each customer basically, for the average gross margin method, each customer basically must make the same contribution to paying non-food and generating a profit. Reduces the price range, which is very important because as we've seen as well, the big price range on your menu is not really beneficial for the customers buying something, because they will probably only take the cheaper items, because the high-priced items, for example, are way too high price. And this is very easy to use if you have financial information. Obviously, if you don't have financial information, then you really have to go for the pricing factors, because especially if you start, for example, you would much rather use pricing factors than the average unit gross margin method, because you don't have any historical data. So let's go to the Omnis Laws. This is part of the menu engineering. There are 4 steps basically in this. First, what you do with... okay, perfect. Thanks a lot, Alex. Exactly, all the slides exactly like that are on the EHL recap page as well. So first of all, you have to decide the price range of the category. So the price range shouldn't be higher than 2.5 to 3, which basically means that this is a factor that shouldn't be 3 times higher than your lowest price, the highest price. So this is what you need to take into consideration for the price range. Perfect. So now you have the price spread. We have 3 different price ranges. So let's say we have dishes from a price from 8 to 26 for 8 different dishes for the category. So now what we do first is we subtract 8 francs from the 26 francs. So we have 18 divided by 3 is the price range, which the price range is 6. 3, we use this factor here because we have 3 different price ranges, lower, middle, and upper range. And then we know that's what we can do. So now we have an increase of, from 8, we have an increase of price of 6 per category. So that means from 8 to 14, this is 25%, 14 to 20 should be 50%, and 20 to 26 should be, again, 25%. So now with the 8 dishes we have here, we can actually do that. So we know, okay, we have 25%, just 2 dishes, 4 dishes, and 2 dishes again for the top price. This is very important to know, so you can also calculate and adapt the recipes and your dishes you're offering, just to know, so have this price spread. Then 3 is supply and demand. We know the average check. We have to also calculate the popularity, but what we do is the average check is the revenue in a category and divided by the quantity sold in a given category. And the sum of sales prices in the category, number of dishes sold in the category is average menu price. Then you divide the average check by the average menu price, and this gives you X, which is, and now we can interpret those ratios. This is then per dish, which means then you can have, okay, 0.9 is a good price to value relationship. Smaller than 0.9 is too expensive for a client, and above 1 is you could slightly increase the price because you're not making enough profit on it. And then here we go. This is just a training a little bit. Basically, what you have here is what is the supply and demand ratio. What we have to do is first we are calculating all the average menu price, which is all the sales prices divided by the number of dishes we have, which is 9 in this case. Then the average check, which is 7, and the average menu price, so divided by 0.86, which is a bit lower than we would like. So we have here, for example, we said that lower than 0.9 is a bit too expensive for the client, so we should slightly probably cut cost or reduce our selling price. Then very important is also the promotion. In the end, this is the last one. What we do is with promotional pricing, as we said before, is that we are selling something for a bit cheaper than what we actually would like to, because it's an attractive price, and you can do a dish of the day, for example, that's what it is, or if you want to sell out the stock, for example. They should all come for the promotional pricing, they should all come for the middle range price category, because there you have the most wiggle room to play with dishes as well. Cool, those are the Omnis Laws. Very simple if you follow those 4 steps. I think very well achievable. So purchasing, let's go over that. Procurement and purchasing, what is the difference? Purchasing is what you requesting quotation, approvals, and procurement is the vendor selection. Procurement is basically the bigger picture, and then purchasing is within that, because I think we're only going to talk about purchasing in this case. What we want to do is we maintain adequate supply, minimize investments, maintain a competitive position. That's why the purchasing is very important, because in the end we need to have the best prices to make the best food, so we have to also have the best quality produce to make a nice range, or to get a good profit on it as well, and obviously to satisfy the customer, which is the most important thing. Supply chain flow, basically this is the usual one, but we are also looking at difference to material, informational, and cash flow, which suppliers, manufacturers, distributors, retailers, and customers. What we are trying to do now is, with, for example, farm to table, we're trying to cut this supply chain very short. Farm to table is basically we go directly to the farmer, he gives us the products, and we directly turn it into a delicious dish in the restaurant. Basically, yeah. Perfect. Now this is important. I think there was a question on that in the mock or in the final, if I'm not wrong. This is basically the timelines of the documents we are following. So first of all, we have to have a spec sheet. We're going to go through after that what the spec sheets are. Purchase request, bid sheet, purchase order. Then we go to the receiving, and the receiving process is a different process, again, a separate one. We're also going to look at that invoice and the credit note in the end. A question to you guys. Do you want to go through the documents, or do you know what each of them are, and should we just skip this part because it's I don't know how.
Yeah, I think we could skip it because it's clear in his list.
It's pretty clear, right? Yeah. Anyone has a different opinion? One explanation? Otherwise, everything is basically here. Exactly what we have in the spec sheet, etc., etc. Cool. In this purchasing sources. So yeah, here we go. Different purchasing sources as well, guys. Should I tell you about that or not? Do you know the difference? Yeah? No?
Yeah, all good.
Okay, cool, perfect. It's also not very difficult to know. So this is basically about the quantity, about the reordering process. We have to have the maximum level, reorder level, then I have the security level as well, obviously on which basis your what security stock you have in case you use more, or you something that you have to throw away, or the delivery has delay. You need always to have a security stock. This is very important. And then you also have the lead time, obviously, at the reorder level you have. This is also very important that you set that, depending obviously on the season as well, etc., and on the different products. Receiving, issuing inventory. Let's go. Receiving problems. Also, I think self-explanatory. Here we go. Ideal procedure for checking F&B goods. You have to check all your documents. You have to check the merchandise when it arrives. And if something is not okay, then definitely you have to call back and ask for a refund or for another, another product. So, credit memo. The credit memo is just basically if you have poor quality or incorrect pricing, and so on and so on. Now we have AP versus EP. Guys, do you know how to calculate that? The yield and as purchased and edible portion prices, net weight, is that something we should go over, or yeah, no, maybe.
Can you briefly just go over it?
Okay, yeah, I could just explain it. So basically, as purchased, I see that for some reason it has something has deleted here. I will fill it in afterwards. As purchased is the purchase price that you have when you're purchasing it. So basically, let's say you have artichokes, which is very famous for, it's very difficult to prepare because you have quite a big bulb, but you can only use a very tiny percentage. So let's say you have a yield of 5%. That means for artichokes, for example, you only 5%, which means 95% of the artichoke is waste, which is obviously not so good. This will decrease your yield, and also obviously in the recipe you're not using the as purchased weight, but you're using the edible portion, which is always as purchased weight times the percentage of yield you have. That's the edible portion you have. Obviously, if you then decrease to a net weight, you're increasing your costs per weight. This is very important. Yes, Jonathan. EP cost will always be higher, but EP weight is lower. EP cost is higher. That's important because you can never, very rarely use everything that you're buying, purchasing. Types of stock also, I think, self-explanatory. So now ABC method, we can categorize a stock in basically 3 different items, or A items, which are for making about 20%. With 20% of the items, you're making about 70% of the annual consumption, which are very high items that are like very expensive. Let's put it's a very expensive bottle of wine, or just some specific produce that, for example, can be Wagyu beef, for example, etc., etc. This is very important that you have a very strict control over it. What I've seen in internships, for example, what they do is they have a locked fridge specifically for those items, where only the restaurant manager and maybe the deputy restaurant manager have access to it, because otherwise at least from my experience, we would always go and have a drink after work, and maybe take some open wine bottles and finish them. So that's definitely what can't happen to you with A items, because you have to have strict control in them. Then B items are 30% of the items, which account for about 25% of the annual consumption, which you just do sporadic controls, inventory every so often. And C items, for example, is, let's say, for example, salt, or if you're not a barbecue place, pepper, or any like spice and stuff. That is also 50% of the items, but they don't account for a lot, because either you're using very low quantity of it, or they just don't make a lot of profit. So this is a very minimal control. Obviously, if someone takes a tablespoon of salt, you're not gonna fire them because of that, obviously. So action plan for A, B, and C are different, because A products are also perishable. We have to have also very physical control over it. And yeah, I will let you also read quickly through that. I think it's very self-explanatory, just so you have a quick overview. If you have any questions, please ask. I'm gonna have another sip. Cool, let's move on. This is the bin card. This is a very good tool to control the bulk stock and sellers and storerooms. You have one card of every item. So this is how you can actually really control the number of items that you would have in stock that you've sold, and then the balance you have in the end of each product, which is very important. So you have a bit of control, how much went waste, how much did you lose track in between storage and consumption, and so on and so on. Requisition form also pretty self-explanatory. Good. Here we go. Food inventory cost control. Basically, what we do here is we have opening storeroom plus today's storeroom minus values of issues from storeroom equals storeroom book value. Accountability, theft, and so on and so on is obviously accounted for that. What is important, I think I forgot to have that here. Okay, yeah. So basically also very important, food consumed is not equal to food sold. Because sometimes, of course, as I think we've had in class as well, and we've all seen, is that you sometimes give stuff out for free. You all sometimes give stuff out to staff for a lower price or to managers and so on and so on. So this is not the same value, so should not calculate with that value. Then that's basically inventory value. Valuation method is the last purchase price. Item search is valued as the item last purchased, and then this is basically what we did is varies to calculate the weighted average price. Is you're weighting the calculating average price over all the stock, and this is basically how you value each and every item. So basically, the higher the closing inventory value is, the lower the cost of goods sold will be, equals to the higher profit, obviously. And the lower the closing inventory value, the higher the cost of goods sold, which is lower profit. Obviously, depends also on the items. But this is just a very easy conclusion, I guess. So food terms. Just let's quickly go over the terms. This is, as I said before, I think now we have this, what I was talking about before. So the food available for sale is the sum of the beginning inventory plus the purchases made. This is what you have in stock, and this is what you can sell. Food costs consumed is the value of food used and consumed, but it's also taking into account theft, as I said, and so on and so on. And the food cost sold is what you actually can see numerically in your cash register, on your micros system, etc., etc. This is what you've actually sold. And then the potential food cost is the theoretical, ideal standard or attainable cost. Recipes were perfectly respected. So this is, pretty clear. Beginning purchases and ending inventory. Nothing major here. So, what we have to do here is, what to do here is the cost of direct purchases. We have to calculate daily, everything daily, cost of store issues, what we do, what everything enters our storage room, and then inter-kitchen transfer. This is also plus or minus depending on how you're moving in a big operation, let's say multiple restaurants, how you're moving certain items between certain restaurants. This is, of course, because you have different storerooms for different kitchens, because you can't always have one central storeroom for most of the stuff. Then if you're doing it between departments, you are actually adjusting, so you're crediting something. So for example, if the kitchen is delivering something, let's say pineapples to room service, they will have to credit this obviously in their storeroom because it went out. And cost of employee meals as well is the same, and then you get the daily food cost about that. What you do monthly as well, same thing, especially for cooking, wine, and everything. And so this is basically just an expanded a bit model that what you're not doing daily, but the large quantity stuff that you're only controlling monthly. I think also pretty self-explanatory. So food costs, which is the transfers. Here what we can see is that you transfer food from the kitchen, and then your food transferred from the kitchen. So you add that to the beverage cost, which is, wait 1 second. Exactly, this is the transfer between outlets and services. You credit it on one side, you debit it on the other side, because obviously it goes to different departments. So, yeah, also quickly have a read through that. Calculation of cost of sales for individual products categories, estimating daily cost of sales. This is why I use the cost of sales percentage, because that's how you also can keep track over your storage. Okay. So potential food cost, how you do that? Basically, you write your recipes first and sub-recipes for each dish. So, for example, if you have multiple items on a dish, you have the sauce and so on and so on. You're doing that, and you have the yield, the butcher test. The butcher test is what we did before. What I've explained is the AP and EP. So as purchased and the actual amount that you can use. And for a dish, it helps to price each dish and give your food cost percentage per dish. This is important just so you also know how high the markup is, etc., etc. And the quantity sold times the cost of dish is the potential food cost, basically. This is what you have, and then of course this depends on, again, seasonality and your stock, etc., etc. And this is very important that you have the potential food cost, because the potential food cost you always have to compare it with the actual food cost you have. So that means, for example, if you have too high of food cost in compared to potential food cost, if you compare to, for example, to your recipes, that means that, for example, chefs have been using too much of a certain ingredient that they shouldn't have, or too little, or they have eaten it somewhere, I don't know. Always happens. It's a human factor that you can't really control. But if you can control this, the potential food cost, and you can compare it, it's a pretty good tool. So as for you to know as a manager where you stand and how you can deal with that. Book inventory. Yeah, this is a very easy calculation as well. Nothing. Beverage cost is pretty much the same as food cost, actually, nothing major as well. So the beverage cost available for sale, beverage consumed, is the total value that's being consumed, not the one that has been sold. And the beginning inventory, purchases, ending inventory is exactly the same. The beverage cost percentage in this case as well, the cost of beverages sold divided by the beverage sales is the beverage cost percentage. And this is also very important that you have also physical inventory, inventory of the bars, and compare the cost of beverages sold to beverages sales obtained. Yeah, exactly. That's what we have discussed. So this is the same as we have had before, just before in the food cost. This is what you do monthly. Purchases, transfer food from bars, for food outlets to bar outlets, beverages for cooking, which you minus, and then closing inventory, and then of course steward sales, promotional expenses, employee relations, and so on and so on. That's what you also minus from the cost of beverages sold, because this is everything that's what you've consumed is not what you've sold in the end. Sales value methods. So what we do here is we have 100 centiliter bottle, so which is 1 liter. We have a 2% spillage rate, which is 2 centiliters per liter, and then the potential use is 98 centiliters. So potential drinks is 98 divided by 5, because we can make 5 drinks out of this. And then the price is 14, and the potential revenue is 14 times 19.6, which then gives you the 274.4. So now you have actual sales of 250. What do you do with this? Okay, you can actually calculate the gap between what you've actually sold and what the potential revenue is. And this difference is in this case 1.7 drinks, because you have to divide again by 14 by the price, so you know the amount of drinks you're missing, and then these 2 drinks are missing. Probably increased spillage, or some staff drank it, which is in most cases the case. So also very important to calculate that. Is basically the same as in food costs. You do the same thing. This is again about the inventory, opening and closing inventory. So this is how you can calculate that, the sales value method. So what are the issues? I will quickly let you read that as well. Basically, what there is for the customer side is diluting liquor to make up for missing beverage, which is always know what you want to do because you're diluting also flavor. Bring your own bottles and sell it. This is also something that's interesting, but obviously not what you want. So no employee can bring their own bottles and sell it to a cheaper price to the customers. That's not possible. And obviously, what also has happened, it's serving, for example, a bottle of Beluga vodka in a Beluga bottle, which is actually very cheap vodka. That you can't obviously do as well. Cool. Possible actions. What you can do to prevent all of that is use standard shot glasses, mystery shoppers. We've had that as well in AP. The mystery guests that are basically looking if you're respecting the rules, if you're respecting the recipes, etc., etc. So everything you can standardize as well. Also, I think nothing major that you have to know about that. Policies and regulations. Using guest checks, develop and use standard recipes. Also pretty self-explanatory, I guess. If you want to have a read through it, please do. Now we are almost done. Oh, I've only been almost now. That's great. Perfect. So the terms we have again, payroll and labor expenses. The payroll refers to salaries and wages paid to employees, and labor expense includes also stuff that is not other labor-related costs, which means, for example, if we have used office material or something else, that is a labor expense but not in the payroll. It just will be accounted differently. So you have minimum staff, then you have, this is the fixed payroll, which is part of the fixed costs that we've discussed before, and then of course the variable payroll, which is hourly seasonal staff and overtime that you have to do, which is also counted variable. So this is very important to know that we have pretty much all control over fixed costs and how many people we hire fixed. And the variable payroll is everything on how you manage your staff, how many people you hire, and how you control the rest of your operations. So you can minimize your variable cost quite significantly if you know how to staff your people, and that does decrease your labor cost. So yeah, again, prime costs, how much should it be for an F&B outlet? 60 to 65%. Between food and labor is less important. How it's broken down and how much the percentages are within this, very easy. Always calculate the percentage of revenue, how much revenue you're making, or in comparison to the amount of labor you have, especially for fixed labor, because in the end, what you do is if you're making less revenue, then you also don't need to have as many staff, because normally you don't have as many guests. So that's basically that. And also the labor percentage was what should be for the from the previous day. You should have that. I can't talk from experience here. That it's just something that has been said. Labor efficiency is the cost of labor employed divided by the total revenues, which is then equals to the labor cost in percentage. This is very important because now you know how much of the revenue for that labor accounts for. And if you have, for example, a certain amount of productivity that you need, is the outputs divided by inputs, and this is how you can also standardize. So you see that, for example, in this case, we have output of 600 pots to wash and 4 employees. That means 150 pots per washer. So this helps you to calculate how much staff you need in each instance, and that's the productivity ratio, also quite important to know. So you can standardize, you can reduce your labor cost, and thus make a bit more profit. Productivity, it's definitely can be expressed in different in different terms. F&B revenue covers and average check for customers, how productive the customer is in this case. The payroll is hours, can be also hourly salary, and so on and so on. So select productivity measures, forecast revenue, orders, establish staffing requirements, schedule staff, and evaluate labor control results. This is just basically what you need to do to calculate the productivity and then forecast, plan your stuff, and then redo the whole thing just so you have the basic control over everything. Cool. Guys, that was it. Thank you very much for listening. It was pretty brief, briefer than I expected. Also a lot of questions, so that's cool. If you have any questions, please let me know. I'd like to help you. Other than that, you have, as I said, we have the whole presentation on EHL Recap. Check it out if you need to look for something, or of course the stuff on LMS from the teacher is as well up there.
Vielen Dank.
Cool. Bitteschön, sehr gerne. You're welcome, guys. All the best for your exams, and I honestly hope to see a lot of you back on campus next semester. Let's hope this pandemic will go away at some point. Have a nice day, guys. Good evening and good weekend. Bye-bye.